Hi everyone, thank you for joining me here today for our Q2 market update. I wanted to try something a little bit differently this time round since we haven't been able to sit down face to face in the last few months. I know we've done a lot of Zoom calls and they have been very well received. However, I thought I'd try a new format and see how you like it. So we had been talking about a recession for quite a few years now, and we had made incremental changes along the way to prepare ourselves. However, we didn't see any imminent risk, towards the end of 2019. Fast forward to February, March of 2020, we saw that what takes place typically over a span of months took place over a span of weeks as the economy and the markets corrected and contracted in March, as governments had to shut down economies to be able to try and contain the virus. Now, since March 24th, we have had significant recovery in the stock market, which begs the question, why this sudden rebound and is it sustainable? So when we talk about the stock market, we are really looking at treating markets as a forward indicator. Markets are always acting in anticipation of what is to come. So think of it almost like if you're boarding a plane to go on a vacation, chances are you're more excited as you're boarding that plane as opposed to when you're physically sitting on the beach having a beer. So similar to that, markets are anticipating what is to come. They're looking at what will 2021 earnings look like. And they're looking at, are we getting incrementally better or incrementally worse week by week? Now, since April, we have noticed that the data has been moving in a more positive direction, whether we're looking at the number of COVID cases, unemployment rates, consumption levels, and so on, which has stimulated more confidence in the markets. Secondly, whenever we're looking at the amount of stimulus that we have been receiving, whether it's fiscal stimulus or monetary stimulus, there have been multiple measures implemented very quickly and very effectively this time round to be able to try and avoid a health crisis turning into a financial crisis. So whether we're referring to the CERB, lowering of interest rates, business loans or relief programs, bond purchase programs, there have been different measures implemented to be able to try and maintain financial stability as much as possible, which has also helped the markets and encouraged businesses and households to continue spending where required as much as possible. Now, having said that, I wouldn't say that we are out of the woods just yet. There are still different risks present that we need to factor in when we're thinking about the economic recovery, and it will be a more gradual process, kind of like if you're going down the elevator but climbing back up the stairs. There are some different risks that we need to take into account. So the first would be the fact that there may still be a second round of COVID that we need to factor in. We don't have a vaccine yet. That there will still be a lag before it is fully developed, tested, and available to the public for use. So, it will still take some time before businesses can fully reopen and operate at full capacity, and before confidence comes back up enough to be able to have those businesses and have those services be consumed at the 2019 level. So that will still take some time. We also have the elections coming up in November, and there are some potential policy changes that can come forth through that. We've already had trade policy changes that have taken place in the last few months. However, there may still be additional policy changes with respect to what corporate taxes will look like, what companies are allowed to do with their cash on hand. Are they allowed to buy back shares, or do they have to deploy that cash into other measures, whether it's being a little bit more environmentally friendly, socially conscious, and so on. So there may be some policy changes there that will determine how companies will have to run their operations going forward. We also have to factor in unemployment numbers. So far, we've been talking about unemployment that has been directly related to COVID. However, the longer we stay out of business, or the longer it takes for us to gradually reopen businesses, the more likely it is for some of those temporary job losses or job layoffs to turn into permanent job losses. So that's another figure that we'll have more clarity on in the coming months. Now, having said that, I do want to say that markets are never devoid of risk. There is always some risk present in the economy at any given period of time. It's something that we know to expect. So it's more so a matter of making sure we are well positioned to be able to navigate through those different risks that are present and take advantage of upcoming opportunities that become available through every crisis as well. So the second question that I wanted to address is, why is there such a big discrepancy between the actual economy and the stock market? So keep in mind that the stock market, again, is a forward indicator. It will act in anticipation of what's to come. So markets will likely move ahead of the economic recovery itself. But the second factor to that is the fact that when we're thinking about an index, so let's take the S&P 500 as an example. Think about companies like Amazon, Google, Microsoft that make up a large part of that index, which are companies who have been able to operate during this crisis, who have been able to maybe even gain more market share because some of the smaller competitors weren't able to function as much. So they have been able to operate and they have been able to grow during this time relative to the underlying economic numbers, which may be more reflective or which will include, in addition to those larger companies, which will include smaller businesses that had to lay off their workers, that had to close shop, and so on. So sometimes whenever we're looking at the markets and the economy, those numbers, there may be a discrepancy between what are the numbers reflecting, because we might not be seeing the full economy, based on the stock market that we're, or the index that we're comparing the market to. The second is the fact that there has been a lot of stimulus measures that have been implemented that have supported a lot of businesses that may not have survived otherwise. So there have been measures, there have been a lot of companies who were able to get through this crisis and avoid bankruptcy so far because of the stimulus measures that were implemented. However, the longer it takes to reopen businesses and the longer it takes to go back to full capacity, the more likely some of those businesses may also have to file for bankruptcy later on. So markets, again, have priced in a certain level of bad news in the coming months and will move as a reaction to whether what we see is better or worse than what was already priced in. So this is something that we know to expect, in the coming months. The third factor is the fact that even though unemployment numbers were high, there was a baseline level of income that was maintained during this time because of programs like the CERB, where there was a certain level of consumption that was able to be maintained. Now, we have seen consumption levels increase in the goods side of the economy, where we are able to still purchase items online, and there has been a certain level of pent-up demand that has allowed us to do so. However, there will still be a lag before we see that replicated on the services side of the economy. So we will see that there will still be some time before we see that full recovery. Now, factoring all of this in, where do we go from here? What can we do given the situation that we're in? So the first thing that I would really like to emphasize is the fact that it is extremely important to maintain that long-term allocation to stay the course. We had structured the portfolio from day one to be able to weather through these kind of storms, knowing to expect it at some point in time, and expect it as multiple times over our investing time horizon. So it is important to maintain that allocation, knowing full well that we already have our safety, our growth, our secular growers, our more consistent dividend payers. We have that geographical diversification as well. So we are well positioned to be able to not only weather through these storms, but also take advantage of buying opportunities. And one of the opportunities that I always like to mention is the fact that we have a daily rebalancing feature embedded into the portfolios, where every single time markets go down and the bonds are appreciating, we're able to use some of those bonds to be able to buy back companies that are now even cheaper in price, to be able to take advantage of those buying opportunities, and vice versa. As markets climb back up, lock in those profits as well back into safety. And that takes place on a daily basis alongside buys that are taking place inside the investments themselves. As a second step to that, if you notice that you have the financial capacity, you have the cash flow to be able to add to the portfolio, this is something that a lot of clients have been taking advantage of to be able to make use of, the lower prices that we've been seeing over the last few weeks. So this is something that we can certainly discuss one-on-one. The buying opportunities would be specific to what the time horizon is, so we can definitely discuss this one-on-one. The third portion is really just assessing cash flow. Most of us have noticed that aside from groceries and the regular household expenses, there isn't that much more to it to spend money on at the moment. So there may be an opportunity to be able to rebuild some of those emergency savings funds, and also look at alternate sources of cash flow, so that should this occur at a later stage of retirement, we have the opportunity to be able to make sure that we're giving ourselves options as to where that money should come from. Manulife One is something that a lot of clients have been taking advantage of in the last few months. So if that's something that you'd like to revisit, then I'd be more than happy to be able to go through that with you. Doing an overall financial health check would be important, in my opinion, just to be able to help better understand where are my investments, how is my cash flow structured, what is my insurance coverages that I have, is it enough, do I need anything else, just to be able to understand what is it that we have. And if you would like to go through this together or update the numbers into the financial plan, I'll be more than happy to be able to go through that with you. So very, very quickly, just some questions that have been that I've been receiving a lot over the last few weeks. So I just picked the top 3 that have been coming up most often. Is it a good time to invest? So again, this is case by case, and I'll be more than happy to go through this with you to be able to determine should we be investing? How should we be investing? And where should we be investing based on how we're structured right now and what the objective is that you have for those funds. My company is going through a restructuring. They're laying off, some staff. What should I be aware of? So again, hopefully this doesn't affect you. However, if it does, it's always important to understand what are the coverages that you have. What will you have in your, as you transition into a new company? Do you have enough? Do you need more? Do you need less? Making sure that you have the right fit. So whether this is, life, critical illness, disability coverage, or health coverage, feel free to reach out, and I'd be happy to be able to go through that with you. My parents have named me the executor. What should I be thinking about? So this is a topic that has come up more and more. It's been coming up quite a bit over the last few years, but has been more prevalent in the last few months as well. There are several steps that can be taken to be able to simplify the process and enhance the experience for the family ahead of time. So if you find that you are an executor, or you do have older parents that should be reviewing the way things are structured with respect to their wills and so on, feel free to reach out. I'd be more than happy to go through some ideas that I've implemented for multiple families, just to be able to simplify that process and to be able to make sure that when that time comes, you're spending your time and energy focusing on your family as opposed to focusing on the financial matters at that point in time. So you're able to devote that time to what's most important. So I wanted to say thank you for your time. Thank you for listening in. And as always, if you have any questions, if there's anything that I've said that you wanted to dive into deeper, if you'd like to update the financial plan, or just again, go over the investments that we're holding on to, feel free to reach out. You know how to get a hold of me. Feel free to use the booking link in my email signature to be able to set a time, and I'll be more than happy to be able to go through this with you. So I thank you for joining. Thank you for being with me here today, and I hope you're staying happy, you're staying healthy, and you're staying safe. Thank you.